Welcome to the Genghis Weekly Investor Briefing. Today is October 5th, 2020, and we have something special lined up for you. At Genghis Capital, our aim is to make investments accessible and to share the information, knowledge, and technology through our application Jacuzzi that makes investing less a reserve of the few, but an avenue in which to grow an avenue through which a growing majority can participate in our ever-deepening financial markets in Kenya. Now, our research department works constantly to develop actionable sector reports, and this includes the Genghis Weekly Cross-Asset Strategy that is the basis of this briefing that we're attending today. Now, this briefing and the weekly report shares with clients the outlook for the week when it comes to share trading, fixed income, derivatives, and contains pertinent macroeconomic insights, all with the aim of taking the guesswork out of investing. Now, today is a very special briefing because we have the immense honor of hosting a guest speaker from the Nairobi Securities Exchange. His name is Geoffrey Radier. You can see him over there. And he's the equity derivative specialist at the NSE. Now, the NSE at the end of September released the year-to-date trading highlights and performance of the derivatives market. Geoffrey will guide us through the report, indicating where value was to be made, so that as we begin this final quarter of 2020, we're able to do so with clear targets in sight. Now, derivatives is an example of how the Kenyan financial market is growing, and to understand and be a part of it now is how you'll be able to differentiate yourself as an investor. So we hope you'll enjoy that guest speaker presentation by Radier. Now, our standard briefing format remains. I'll be handing over the session to our research analyst, that is Gerald, who will guide us through equities, which is always something that we get a lot of engagement, and we love that. And then he'll be followed by Churchill, who will present to us microeconomic insights for the week, as well as what we can look out for in fixed income, that's treasury bills and bonds. Thereafter, we'll get to the main event, which is our guest speaker, and I know I'm looking forward to that. Now, remember that the Genghis Weekly Investor Briefing is an interactive one. Please feel free to use the Q&A section at any time during the presentation to send in any questions you may have, as well as using the chat function for any comments you may want to share with the team. And at the end of the session, or rather at the end of the presentation, our research team, as well as our guest speaker, will be able to address them all. So welcome, buckle in, and let's get started. Gerald, over to you.
Thank you, Damaris, and good morning, everyone. Let me share my screen with you. So yes, a recap of last week of what happened in the market. I think we are continuing to see a market that still doesn't have a clear trend, a clear direction. Very marginal movements in both the indices and the NSE all-share index, about 0.1% negative. Last week it was about positive 0.1%. NSE 20 plus 0.2%. I think last week it was fairly flat. So we are still seeing a market that is yet to pick up a trend. I think it reflects the uncertainty that the current environment is still in, despite this presidential speech last week where he relaxed some of the measures. I think the market is yet to find its footing in terms of interpreting where this is going to take the business environment. So turnover declined about 56% to about 1.5 billion. That was quite low for a weekly turnover. I think we have seen turnover of one-off about 4 point something billion about 2 weeks ago, but that was quite unusual. So last week was very low in terms of market activity at the NSE. So foreign participation 72.9. This came down from about 79%. And they're still exiting the market. I think the outflows last week was quite even, spread evenly across the key stocks that foreign investors traded. This was mainly Equity Group, KCB, ABL, and Safaricom. Just the usual activity in those key stocks. So the key stock that foreign investors were buying was Safaricom, about I think 80 million shillings. But this was quite a tactical strategy, because in the previous week they were selling out of Safaricom. So a lot of tactical strategies across Safaricom for the last couple of weeks. So the top traded counters are the usual: Safaricom, KCB, Equity, ABL. Then there was ABSA. I think these are basically the stocks that have the most interest. They have the largest fundamentals, the best fundamentals, and that is why you'll always find them as the key traded stocks at the NSE. Now, in terms of where we are trading at compared to peers, not much has changed compared to previous week. I think if you look at our price earnings, it's about 9.2, very attractive compared to the African average, about 11.7. And then the dividend yield is also very attractive, 5.3. Compared to African average, about 4.6%. So this is definitely tells you that our market is a very attractive entry point compared to the average African peer. Ideas for the week: still long-term biased towards stocks which have very good fundamentals. And this week, our key focus is EABL. So last week, the president reopened bars and hotels. And given that our expectations was this will be reopened in January, then we are talking about business that is heading to a very good season. I think November, December is usually the best months for them. The festivities that time. So we are going to see some pickup in volumes compared to where they have been for the last couple of months. And as you know, EBL relies heavily on, they push most of their volumes through the physical facilities. Yes, they have been talking about consumption from home, but this doesn't push as much volumes as the bars and the hotels. So this is one of the key things going forward for them. And then if you look at the price, it has held at 160 shillings. So despite the reopening and the positive vibe that has been there, the stock has barely moved at 160. So we still see it, see that price point as a very good, attractive point. Kenya, yes, we are bringing it back again. I think it's books closure this Friday. We have talked about Kenya trading at significant discount to its book value, 0.2. Then we are looking at the dividend as an icing on this stock. So long-term investors, value investors, should look favorably at Kenya. Corporate calendar, not much new. Kenya this Friday. Then we have Kenyan as a dividend on 22nd of October. So investors should position for those two stocks. So Churchill could take over for macro and FI. Thank you.
Thank you, Gerald. Let me share my screen. As usual, I'll start my presentation on the economic calendar and just review of what happened last week. As expected, the September Monetary Policy Committee retained the CBA rate at 7%. That was widely expected. And the other report that came out was the inflation rate for the month of September. The headline number was at 4.2%. The core inflation was at 1.7%. There's been a steady decline on core inflation, actually even prior to COVID-19. and that has been exacerbated by COVID-19. And we still see that it's a proxy of the demand pressure in the economy. So that has been quite stable at 1.7%. In terms of food and fuel inflation, they both remain steady compared to August inflation at 5.2% and 10.7% respectively. Looking at some of the outlook, economic calendar outlook, we have PMI, that is the Purchasing Managers Index. This is relatively a proxy of the private sector business sentiment at any given month. So any number above 50 is showing that there's some expansion in the sentiment, and any number below 50 showing that there's some contraction in the business sentiment. I think the number for August was around 54, but that basically was coming from the lows that we saw in the second quarter periods between April up until June. So that point is expected, I think, it should be expected in 1 hour, 15 minutes time at around 10:30 a.m. What was supposed to be released last week, but that has been delayed, that was the quarterly reports on the GDP second quarter, and also the balance of payment reports for the second quarter. It's to be advised when these delayed prints will be put out, but we'll be on the lookout. Could be this week, could be next week, but we'll be on the lookout for that. Moving on to the fixed income review, in terms of last week's secondary market activity, total turnover was around 16.1 billion. So that was an increase of around 32% week-on-week basis. Majorly, the trades that were executed last week was on the infrastructure bond papers, and in particularly the 5-year papers. We saw some robust activity even on the 5-year papers. That's on the fixed rate bonds. In terms of the T-bill segment, we had a performance rate of 64.9%. That was an equivalent of 15.6 billion bids that were received by CBK. Just looking at how the yields have, the trajectory of the yields since they hit a lows of recent lows in mid-July, we've seen that on average between 91-day, 182-day, and 364-day, there's been a 0.33% up increase from the recent lows that were marked in mid-July. So there's been a combination of factors towards that. And one of the things that we are flagging of late is now what we call normalizing in the liquidity trends in the markets, which will be focused shortly. Just looking at even last week's liquidity trends in terms of the average interbank rate, we saw it climbing by 0.27% on a week-on-week basis to an average of 3.54% last week. In terms of the OMO, that is open market operations, whereby CBK comes in and any given day they look at assess the liquidity trends in the banking sector. If there's excess liquidity, so it necessitates a mop-up of liquidity. That is through repo instruments, and if liquidity trend is quite lower, so they have to inject liquidity, but that mainly is been through reverse repo, and that played out in the previous week where CBK came out throughout the whole of the previous week through reverse repo just to inject liquidity, and that is a pointer of the tightened liquidity in the banking sector. Over the course of last week, though, it was quite different, whereby CBK mainly stayed out of liquidity intervention, so it was more or less at par at where CBK is looking at. Just looking at the net domestic borrowing, as at the end of last week, we are seeing 246.6 billion already has been borrowed in terms of both T-bills and T-bonds. This is our estimates, and if we include the CBK overdraft facility, we're looking at around 260.8 billion that has already been borrowed so far through the domestic market. So that more or less is a representative of 50% of the initial borrowing target of 94.3 billion. I'm saying initial because there's just looking at some of the reports that has come out from Treasury, we are expecting that even the net domestic borrowing target to increase from this 494 billion that was there initially. Last week, CBK announced this month's primary bond issue. Basically, it will be a reopening of FXD1 2011-20. In layman terms, that was the first 20-year paper that was issued in 2011, and also the reopening of FXD1 2018-25, the first 25-year paper that was issued in 2018. Just because they are reopening and just a focus on individual papers, we are saying in the FXD1 2011-20, the life that is remaining on that bond is 10.6 years, and the bond has a coupon rate of 10%. So if you look at the current implied yield, this is as at the end of last week, that was around 11.58%. And we all remember the building blocks when it comes to fixed income is that if the yield is greater than the coupon rate, the price for that bond is at a discount to par. So you look at it like right now for that FXD1 2011-20, the dirty price is at 94.21. So for every, say, 100,000 as an investor that would like to get into this paper, you'll have to deposit 94,210, and that's the dirty price. By dirty price, I mean that because it's a reopened bond, and bonds pay coupons every 6 months. So by the time you are entering or you're buying into a bond, there's that accrued interest since the last coupon payment that is not entitled to you. So you have to pay that portion to the person who you are selling, whom you are buying the bond from. So inclusive of that accrued interest, that is where the dirty price comes in. So it's 94.21 for this bond, FXD1 2011-20. And if you look at FXD1 2018-25, the life that is remaining on that paper, remember it was issued in 2018. So right now it's around 22.7 years. It has a coupon rate of 13.4%. It's quite higher than even the coupon rate that is offered in FXD1 2011-20. And the implied yield for this paper as at the end of last week was 12.98%. So you find that the implied yield is lower than the coupon rate. So the dirty price or the price is above par. So it's 106.76. So for instance, for a par value of say 100,000, you'll have to invest 106,760 shillings for you to receive 100,000 once this paper matures. So finally, just to look at our week's trade. Right now, we are seeing that there's been investor preference for shorter term bonds in the market just because of the uncertainty due to COVID-19. And as a result of that, we are seeing that there's interest in the at least 5 years papers and below. So our week's trade is FXD1 2018-5. It has a coupon rate of 12.3%, and right now we are recommending buyers of around 9.4% to 9.45% levels. The dirty price is closer to the clean price, meaning that the last coupon payment on this bond was around September 21st. So right now it's hardly 2 weeks since the last coupon payment. So you find that even the clean price, which excludes the accrued interest, is the dirty price, which is inclusive of the accrued interest, is closer to the clean price, which is exclusive of the accrued interest. Let me stop it there, and it's my singular pleasure also to announce to invite our guest speaker this week. That's Geoffrey Radier. Thanks for making time for this week's webinar. And before I start, I just want to mention that one of the trades that you put out in our weekly report is it's a derivative trade whereby our dealers are looking to enter. So they are timing a short on KCB. Right now, I think it closed last week at around 38, 39 levels. So there's a timing that our dealers are looking at, but a short on KCB, and with a target price of 33 shillings and a stop loss at 42 shillings. Anyway, let me not steal the thunder from Radier. Geoffrey, over to you.
Thanks very much, Joshua. I should have let him continue with the derivatives presentation. He already knows the recommended trades. But thank you all so much. Let me just share my screen quickly. Okay, so I'll just take you through the derivative segment of this week's brief. What I've tried to do is just give you, number one, a bit of an appreciation around what the product is, just recognizing that for some of you, this might be the first time you're hearing about the product, or maybe you've heard about it but haven't yet traded or opened an account. So just a bit of what the product is, some of the reports that we had sent out a couple of weeks ago, as Damaris had mentioned, and essentially the value proposition that we have for you with trading this product and jumping into this market. So very quickly, just some textbook definitions. A derivative just means any financial instrument or a product that derives its value from some other underlying asset. So that asset can be anything really. Typically you'll hear about bonds, equities, commodities, currencies even, but just remember that the derivative itself is just a contract between two parties. Now, oftentimes the reason, as with most financial securities, you would be trading them either because you're looking to manage some risk associated with your portfolio, or perhaps you're looking to speculate, take a position, and based on market movements, you're seeking to make a profit. So those fundamentals still remain regardless of whichever financial security you're looking at. So what's just unique about derivatives is it's always based on some underlying asset or security. There's quite a few types of derivative contracts out there. As far as what's available on the NSE and what we've started with, we're starting with futures contracts, and these are based on equities. So Churchill mentioned a short on KCB. I'll actually just speak about that a bit, but that already tells you that then the underlying asset is the KCB share, which is an equity. So in terms of futures contracts, again, what we're looking at here is there's some agreed underlying asset, there's a price for it, and there's some date associated with this contract. So futures contracts have expiry dates, unlike shares which you can buy and hold and sit on indefinitely almost. Futures contracts always have an expiry date, and I'll show you some examples of that. Well, this might not be the full training, so I won't spend too much time on this, but just to take away is that these futures contracts have standardized specifications. I'll show you what some of those look like. They trade on an exchange, of course, and we have daily valuation and settlement. Now, in terms of what's available to you, we have at the moment 7 securities. So you can trade futures contracts on Safaricom, KCB, Equity, ABSA, EABL, BAT, and the NSE 25 share index. In brackets, you'll see just the tickers that we use for the derivatives market, pretty similar to what you're already used to in the equities market. The next column that says initial margin. Initial margin in the derivatives market or in the futures market is the amount of cash that you need to have in your account in order to trade a single contract. So if you wish to trade to buy or to sell one Safaricom contract at the moment, you require at least 3,100 shillings in your account. And what that gets you, if you look at the next column that talks about contract size, what we do is we assign a contract size to each contract. Some of you perhaps may be familiar with trading CFDs or FX online, where you'll see the idea of leverage. So this is pretty similar in that we say one Safaricom contract exposes you to 1,000 underlying shares. One ABSA contract exposes you to 1,000 underlying shares. So this means if you were to trade, buy or sell one, let's go back to Safaricom, say trading at 30 shillings, then the value of your position or the value of your one contract then is 30 shillings times that 1,000. So each contract exposes you to a value of 30,000. And for that, you're required to put down this initial margin of 3,100. And you can see that all the way down, down across the table. So the other thing is that you can now actually even trade the index. So if you wanted to get exposure to the market at large, instead of trying to build up a portfolio with very many different types of stocks, you could opt to trade one index contract, which gives you that exposure. So we began trading in July 2019, so just over a year and a bit. And what we've seen just is a steady pickup in terms of trading activity. A lot of it has been investors, such as I see that many of you on this call, also from the retail segment, retail and individuals. So that's been a strong demographic, so to speak, that's coming for the market. And that's often with many new products and many new markets, the segment that tends to come in early. So from a year-to-date point of view, we've traded a volume of 827. That's the number of contracts traded. In terms of turnover or the value of those contracts traded, just shy of 30 million. And that average daily turnover, just on a sort of straight line average, comes to about 250,000 shillings, average daily turnover. Again, as I said, a lot of this is coming from the retail and high net worth individual segment. Breaking down the same stats in terms of securities that I've traded. So as I'd shown you earlier, the contracts we have available, you'll see that it's a similar trend to what's observed in the equities market in terms of Safaricom and the banks tending to be the most active counters for various reasons. Some around just popularity of lots of portfolios already hold these stocks. Sometimes just fundamental news around the counters. So the banks have seen quite some movement recently, going back even all the way to rate caps coming in, being removed, and of course this COVID period. So you tend to see similar patterns in the derivatives market as well. This is just a representation of the same information, just again showing you that really Safaricom and the banks tend to be the more popular contracts being traded at the moment. But you'll appreciate that the index is also there, and that's one of the value propositions which I'll come to towards the end, is again, you can now actually trade the index itself. So whereas it's often just a benchmark for how maybe the market is doing, this derivatives market or these futures contracts now turn that into a tradable security as well. Open interest in the futures market is quite similar to the concept of market capitalization in the equities market. So what we are talking about when we speak about open interest in this market is how many contracts are outstanding in the market, the same way you talk about how many shares are in issue, right? So in the derivatives market, as I mentioned, remember these contracts have expiry dates. So as investors enter new positions or exit the market, or these contracts expire, you will see open interest rise and fall. And you can then look at open interest both in terms of number of contracts outstanding or the value of those positions. So this has been on a steady increase. You can see just a couple of weeks ago, just before the September expiry, we had gone up to a value of positions of just about 4 million shillings. In terms of number of contracts, that was about, I think, 137. The dip you will see around March actually coincides with around the time that around the onset of the COVID pandemic in the country. So again, as I said, you'll see similar trends across both markets, both the futures markets and the equities market. So as we saw some sell-offs around that time in both markets, then you can see the value of those positions starts to dip around that time. Now, as for some of what we've observed from a trading point of view with, and this is with actual figures, between the start of the year and the September expiry, you can see that generally over the longer stretch of this year, we've seen a general sell-off or decline in valuations in the equities market. And because the futures market now allows you to trade in both directions, that is, you can take a long position, you're buying a security and with the expectation that its value will appreciate, but you can also short a security. Churchill had mentioned shorting KCB, right? Which means you're trading with the expectation that the value of that security will decline. So the reason you're seeing positive returns on the futures side here is because with the futures market, you can actually take what's called a short position. You're expecting that the value of that security will decline. And I'll just show you a breakdown of this. But the reason then you start to see such a difference between the size of those returns, this is net after fees, is the concept of leverage. So because in this market, you are not required to put down the full value of your trade. If you want to do a trade worth 1 million shillings in the equities market, you need to have 1 million shillings down, right, in your account. For the futures market, we collect the initial margin. It's a good faith deposit that you put down upfront. Because that deposit is so much smaller than compared to what you've put in, your returns are significantly enhanced. I've just picked out 2 examples just to show you. Again, we can do other sessions just to go into more depth around the market, but just in terms of what's possible. If we're looking at an investor who had, if you look at the first column, chosen to buy Safaricom shares, and let's say they were looking for an exposure of 500,000 shillings, then they would have required, number one, total funds required, 500,000 shillings. At the beginning of the year, Safaricom was trading at 31.30. I think this was the close of 2nd January. And if they had held that position until September, thereabouts, then exited at 30 shillings, you can see that they would have booked that slight loss. However, if you compare that to an investor who maybe had this expectation that there would be a downturn in the market and they had decided to then come and sell or short Safaricom futures, and they were looking for the same exposure of 500,000, then if you look at total funds required, which is just a combination of your margin requirements, you can see this comes or would have come to around just over 50,000 shillings. So significantly less than what the equities investor would have required, so almost sitting at roughly 10%. The entry price in the futures market, remember these are 2 distinct markets, although they are related, so it's slightly different, but you would have seen that perhaps they would have entered at a level of 31 shillings, 75 cents, and also exited at 30 shillings. Now, because the security actually declined, you can see that this investor actually generated a profit. After all the fees, looking at about 26,000 here, now compare that 26,000 profit to the total funds that had been required from you upfront of the 50,000. So that's why you see your return then in percentage terms then starts to look something like around 51%. So that's the element of leverage. Because you need so little upfront, your returns then compared to what you put in are significantly higher. Now, it's also worth noting that in the same futures market, should the investor have decided to perhaps buy these futures instead or take long exposure and the market went against them, then yes, there would be a loss. You can see, in fact, before fees, it's the same amount, just at 28,000, and then after you remove the fees, coming to 29,680, which again would have leveraged your return in terms of what you had lost compared to what you put in. So it's just to keep in mind that leverage goes both ways. However, the other way you could look at this is if you have up to 500,000 that you are looking to, or any amount really, the market is open for anyone, whatever amount you were looking to invest in the market, you could still put some of that in the equities market and opt to use a smaller amount in the derivatives market and still get the exposure you're looking for. Just my last example in terms of, actually it's the same KCB Churchill had mentioned, but here I'm just comparing start of the year, holding up to September. So you can see with the banks, we've seen significant movement. So at the beginning of the year, they were trading at around the 50, 55 shillings mark, and then came all the way down to around 37 shillings. And again, because we've seen a sell-off in the market, this was also an opportunity to actually profit from market declines. And I think that's one of the key things with this market, so that you're no longer locked in to only waiting for, hoping that you've picked the right stock and that it will appreciate. So you can also, there's also opportunity in downturns in the market. So you can see that in this example, partly because the market moved significantly more, you can see that this investor, for the same target exposure of about 500,000 shillings, was again only required to put down around 54,000 shillings upfront. And by the time they were exiting the trade, would have generated on the short position 155,000 shillings. Now, what's also worth mentioning, and as I said, we can do full trainings for derivatives at some other time, but another key difference with this market is that your profits and losses are settled on a daily basis. So whereas the equities market, you would put down this 500,000 shillings upfront and only realize your P&L upon exit. With the derivatives market, you are only required to put down your margin upfront, and then on a daily basis, as the market is moving, your account is either credited with profits or debited for daily losses as would be made. And your broker would be in touch with you throughout this whole process. So I won't spend too much time, maybe we'll take some more questions during Q&A, but really our value proposition for you is, number one, you can hedge even as an individual investor or retail investor. If you have a portfolio of shares in the equities market and you're concerned about a market decline, you can actually offset those declines by trading in the futures market, so that should that decline materialize, your gain in the futures market offsets losses in the equities market. You now have a wider variety of trading strategies. The first and most powerful being just the concept of shorting securities. So if you think there's going to be a market decline, you can actually profit from that downward movement. Trading the index now gives you exposure to the market as a whole, by and large. For those of you who may be looking for something a bit more advanced, this also brings arbitrage opportunities, because you now have two related markets for essentially the same security. Leverage means your money goes a lot further in terms of what you're required to put in, vis-a-vis the types of profits that you could generate from your account. And just lastly, in terms of your transaction costs, derivatives markets are often markets based on volumes. So you will often find that the transaction fees are significantly lower than trading in the equities market. And this just encourages that continual activity in the market as far as volume of contracts. So if you're also comparing from a cost point of view, it's also a significantly cheaper market to transact in. In terms of counterparty risk, there's an entity, or we have an entity known as NSE Clear, which functions as the clearinghouse for this market. And what this means for you is that once your trade is executed, NSE Clear is always in the middle of that transaction to ensure that the obligations of both parties are always satisfied or honored on a daily basis. So if the market is moving in your favor and you're making profits on a daily basis, you never have to worry about who you've traded with on the other side, or whether or not they will avail funds just to credit into your account. NSE Clear takes care of that counterparty credit risk. Right, thanks so much. I think we'll just move on to the next section.
All right, thank you so much, Geoffrey. I found that presentation very insightful. I think all our participants and attendees did as well. The three biggest takeaway for me are leverage returns. I can put in a low amount of money and get great returns in return. There are, of course, lower trading fees, which is also attractive. And like we said, there's a low capital requirement. So thank you so much for joining us for our briefing today. I think we've really gotten excellent value. Now, awesome. So I think now we'll move to the Q&A section. We have Charles Kiboy. Now, Gerald, you are back, yes. Charles Kiboy asks, your NSE index comparison with the African indices appears to exclude South Africa. Is there any reason for this? And then also, Lois is asking, why would you not recommend Kengen as a buy for sake of the upcoming dividend? So perhaps we could handle those first two questions. Gerald?
Thank you for the good questions. So our African averages are, the comparatives are SSA countries, right? So South Africa is usually not part of the SSA basket of countries because when you look at South Africa, it's usually in the African context, you'd say it is an outlier. It's more of a developed country than it is as a developing country. So in the major indices, they usually compares performance of countries globally. For example, the Morgan Stanley composite indices, they usually average global countries globally in terms of developed countries, developed markets, emerging markets, and then we have frontier markets. So South Africa is usually part of the emerging markets that has countries like China, Malaysia, South Korea, and the like. And then we have frontier markets where most African countries usually are. So that's why we usually don't have South Africa as an SSA. Those two reasons are the reasons we usually don't have South Africa as part of SSA comparatives. The other question was about Kengen. We are not recommending Kengen purely as a dividend stock, but another value stock with the added advantage of a dividend. I think when you look at Kengen compared to most of the businesses or the companies that have a large shareholding by government, is usually an outperformer. I think we like its corporate governance. Management has been very solid. I think the other thing is about its valuation. In fact, if you look at the recent power plant, that is Olkaria 5, that came on board around November last year, its value was about 40 billion, but the value of the entire company right now is about 33 billion. So that kind of, the valuation doesn't make sense, so that the business entirely is valued less than just one of its power plant, right? So if you consider all these factors and then the business is still investing a lot in capacity increases, Carrier 5, as I mentioned, there is another 600 megawatts or so that they are still planning. And then the additional revenue streams that they are looking at across Africa, then you see a business that is consistently investing in winning, and also, in terms of the future prospects of the business generally. So I think the trajectory of the business is good, despite the current valuation where it is at. Thank you.
Okay, thank you so much, Gerald. I also saw on our Twitter page, somebody had asked about the exclusion of South Africa. So that's a good thing you responded to that. Churchill, I'd like you just to address, for the benefit of all attendees, perhaps once again, what is the difference between dirty and clean price? I know we responded directly to Milka, but maybe for the group discussion.
Okay, thanks, Damaris, for that question, which was initially posed by Milka. Let me just state that in any bond valuation, if you look at the price of a bond, it's ideally the future cash flows. You know that bonds, its future cash flows are the coupons that are paid every 6 months. For instance, if there's a bond that has a five-year life or term to maturity, it has 10 semi-annual coupons that will be paid. And assuming that yes, it will pay the 10 semi-annual coupons, and then finally it will pay the par value, which is priced at 100. So in our example, you can see that it's 100,000, and the coupon rate is say 10%. So it means that for every 6 months as an investor, you receive 5,000 of the par value of 100,000. So ideally, any bond pricing is just looking at what is the implied yield or what is the yield that will equate all these future cash flows. That's the 10 semi-annual coupon payments and the principal at the end at the right at today, but it's now pegged on the implied yield. So you find that if, and that's what I was saying, that if an implied yield is greater than the coupon, you find that that bond is at a discount just based on those workings. And if the vice versa is true, if the implied yield is lower than the coupon, you find that the pricing of the bond is above 100 value. So you end up as an investor, not even if the implied yield is greater than a coupon. So for an investor, you will not end up investing 100,000 right now, though you'll get the 100,000 at the end of year 5. But right now you might end up even spending say 96,000 or 98,000. So that's why it's priced at a discount, and the vice versa is true. If the implied yield is lower than the coupon, you'll have what is it called? You'll find that the price is greater than the par value. So for example, of 100,000, you may end up investing say 105,000, but ultimately at year 5 you receive 100,000 back. That's just it. So you find that as you enter a bond that was issued, or because of the coupon payments date, say a bond that is expected to issue the next coupon is in 3 months. So that essentially implies that the previous coupon payment was 3 months from today. I don't know if you're together. We are today is the 5th of October. So the last coupon payment was on the 5th of July. The last one was on 5th of July. The next one is on 5th of January. So, but as you enter now, remember that you are paying, you're buying a bond from somebody who was entitled to get the next coupon payment of the 5,000 of every 100,000. So you need to pay back that difference, which is around 2,500, that had already accrued to the person whom you are buying the bond from. So that's where the notion about accrued interest and dirty price comes in. So bottom line, dirty price is the clean price. So clean price is just looking at the future values of the future cash flow values, excluding future cash flow values, and then plus the accrued interest at any given point. So that's where the dirty price comes in. I hope it's not complicated enough.
Churchill, it's not complicated. You're a natural teacher, and Milka says, yes, we are together. So good job. So the next set of questions are for our guest speaker, Geoffrey. So the first one is, what happens when the contract expires and you're still holding the shares? So I know you'll be able to help Ben Mark with that particular question. Then we have Amani in the chat who asked, how does one get into derivatives? So I think Amani wants to know the processes of perhaps opening a derivatives account and what's needed. And then thirdly, Emmanuel Mureithi is asking, well, first he says, good presentation on derivatives. How does one go about putting in a trade? And could you also give other derivative trade recommendations? Churchill and Gerald, those recommendations are in your bracket. But Jeff can definitely speak to contract expiring, how you go about placing a trade, and what you need actually to open an account. Over to you, Jeff.
Okay, thanks. So let me maybe start with how to get into derivatives. So this actually is pretty straightforward. It's just a matter of you approaching your broker. So Genghis, in this case, the KYC account opening is pretty standard and straightforward in terms of what you'd normally have with opening a normal equities account. Maybe you already have an account with them and it's just adding a derivatives account. So you just need to express your interest to your chosen broker. And the only extra bit of paperwork that would be required is you will sign a separate client agreement for the derivatives market. So that just lays out a bit about how the market operates, what's required from you in terms of funding your account, those margins that I had mentioned. And I think there's a small element as well just around your understanding of the market, just that you're aware of the different nature of risks for this market compared to equities market or the fixed income market. So KYC is pretty standard. You will just sign a separate client agreement specific to this market. After you've done that, in terms of how you go about trading, so essentially you have two options. The one is, and again, very similar to how equities market operates, you can either liaise with your dealer to execute trades on your behalf. So they can either execute trades at their discretion on your behalf, or you can always be issuing instructions to them via email, phone call, whatever you choose. However, there's also the option of trading, executing the trades for yourself. So the brokers can actually give you access to the trading platform, very similar to how you are already able to trade your shares online or via the app now. What might just be required from you is the broker being comfortable that you understand the product, the market. Maybe they might want to spend 1 or 2 sessions with you. So your options then range from all the way from executing for yourself with access to the system, or with just liaising with your dealer to execute deals on your behalf. In terms of other recommendations, Damaris, as you rightly said, Gerald and Churchill would be your advisors there. But what I would say is because the markets move in tandem, and different opportunities will come up here and there, you might find that you can act on the same recommendations for the equities market, right? So I saw earlier that there was a buy on EABL. So you could opt to buy some EABL shares with part of your money, and also opt to buy some EABL futures. So you can actually act on the normal trade recommendations that your brokers will issue from time to time. Something else that's worth mentioning here, without going into specific counters, I think there was a question last week around what about investors who are looking for short-term movements. So because of the leverage in this market, you might take a view that you want to benefit from short-term price swings in a particular counter, 1 or 2 shillings, because you remember these contracts are leveraged, right? 1 to 1,000, 1 to 100. So you can actually profit from that as well. So in terms of recommendations, I would just say a good starting point is to just base it off of the existing research and fundamentals that you have. In terms of what happens on expiry, so just going a bit deeper into how the product works. So remember, these are just contracts. What you have traded or what you have in your portfolio is a contract based on the price of EABL, let's say, right? The simplest way to think about it is it's just a contract that essentially tracks the price of the underlying. So you don't own the shares. What you have or own, quote unquote, is just that contract. When it expires, or what expiry means is just that everyone in the market who holds that contract. So at the moment, the next expiry date is, I think it's 17th December. So on 17th of December, everyone holding a contract with an expiry date of 17th of December, the system will automatically close out your position. So that position or that contract ceases to exist. And at that point, then what you would have in your account is we will refund the initial margin that you had deposited upfront. If you remember in my slides, there was, for example, Safaricom requires about 3,100 shillings per contract as a deposit. So on expiry date, you get that money back into your account. And over time, you've been accumulating your profit and loss. So expiry really just means we return your margins. It's the final day of receiving your profits or losses, and that contract ceases to exist. If you still wish to have exposure to that counter, you can trade another contract. Thanks.
All right, awesome. Those were very comprehensive answers, so thanks for that. There was Mark Bunyi who was also asking something similar, Jeff. He was like, for the derivatives, when the contract ends, do I pay cash, or what I get is loss on profit on the initial amount I paid? So I think, Jeff, you addressed that. He also asks, who determines the contract length? So Jeff, maybe you could just advise who determines the duration of these contracts?
Okay, the simple answer is NSE determines the length. One of the things I'd mentioned is futures contracts are standardized. And one of the ways we standardize them is we say that contracts will last for a period of 3 months at a time. Different exchanges can have different contract lengths. So what we've opted for is to go with quarterly expiry dates. So at any one time, you'll always have an option of 4 expiry dates to trade, starting with a contract expiring in March, and then June, and then September, and then December. You can trade either one. You can trade a December contract in January if you wish, right? Provided there's a counterparty. But the simple answer is the NSE has standardized that to ensure that contracts always run for a period of 3 months.
Okay, brilliant. Now Milka asks, when do you plan to do the derivatives training, and do you also provide training on Forex trading? So Milka, every month we also have a different kind of webinar. It's called a personal investment webinar that we run with our asset management business. So we're definitely going to look at the calendar of activities and see how soon we can schedule a derivatives training. Maybe we will talk to Geoffrey Radier. Nice, we'll do our online petition, have him join us. So we'll definitely keep our clients updated on as soon as we have that scheduled. But I feel like you could become a regular and really get value from all the different kinds of webinars we host. You ask, do we also provide training on Forex trading? And yes, we do. Now, Genghis Capital has partnered with EGM Securities, and through that partnership, we're able to offer our CDS clients access to the FXPesa trading platform. And also, we're able to provide them access to the trainings that take place with our partnership. So presently, we do have trainings that happen once a week. So Milka, I think I'll use the email address you use for registration and just send you over details of this current Forex trading training that's taking place. So thank you so much for that question. Cheriot wants someone to reach out to him about us opening a CDS account with us. We will certainly do that, as well as reach out to John Kimani, who had asked for something similar. So thank you so much for wanting to join our company for that. If I go to the Q&A, there was a question here that was for Gerald. Gerald, you're a very popular guy. You have to tell us your secret. Betty is asking, for HF Group, if she bought it at 33 bob, would you recommend that we sell it at the current trading price? Because she notes that the loss would almost add up to, I think that's 400,000. So maybe you could comment on that, as well as speak to Michael's question. Michael is like, thank you for the excellent presentation. Would you recommend a sell for KCB shares, or should I continue holding them? So Mike, Gerald will talk to you about that, although he had mentioned it a bit earlier. So yeah, Gerald, please.
Yeah, thank you, Damaris. For HF, yes, there's quite a bit of some loss. I think it reflects the performance of the business over the recent couple of years compared to the peers. I think the performance has not been quite good. And looking at the longer term prospects, I think it will be extremely difficult to even aspire a price that is just break even. You know, from 33, I think you have mentioned about 4 shillings. So sometimes, depending on your strategy, you take a loss and put that money into more promising opportunities. I think current market, given it is at multi-year low levels, and especially for the banks, I think these opportunities for a much bigger upside on some of the other counters compared to the gain you'd get from HF. In terms of KCB, no, I wouldn't advise you to sell right now. I don't know what your entry price was. Maybe it was much lower. I think a few weeks ago, KCB was trading at about 30 shillings. Yeah, 52-week low of about 30 shillings. So if you have that upside of about 7-8 shillings, then you could take some profit. But a longer term, I think the case for KCB is still there, very strong case. I think from our recent valuation, we are talking about a valuation of about 50 shillings per share. Definitely, this is not going to be attained in the short term because of the current business environment and how the business is expected to perform. But the longer term prospects after we are past this environment is quite good. So at current price to book about one times book for a business that usually has an ROE 18-20%, but one of the highest in the sector, then I think it's a very good case, a long-term case for maintaining your shares at where they are currently. So it depends on your strategy. Are you a long-term investor? Are you seeking to take opportunity? Yeah. Thank you, Damaris.
You're welcome, Gerald. So I'm seeing a lot of interest pegged around the webinars and the training. So Brian, I have Joyce, I have Jimwangi. We'll definitely make sure we share with you the links to the FX trading training that's currently taking place. I'll do that. Emmanuel Murithi, I've taken note. You'd like us to reach out to you about derivatives account. So that's excellent. We'll definitely do that. In the Q&A, I'm seeing our last question from Ian Mongolia. For FX, is it possible to have the trades done for you or must you execute them yourself? So Ian, what happens is that we facilitate you access to that platform and you trade for yourself. So there is a prerequisite level of knowledge you need to have, and that's also the reason why the trainings take place. So yeah, it's access to the platform, then you trade for yourself. But for derivatives, as Jeff mentioned, derivatives, you have the option of having access to the system to trade for yourself or just allowing your broker to do so for yourself. Mark, I've taken note of your request. Thank you so much. And Lois, we wouldn't forget you. I love seeing so many regular attendees to our session. So we'll definitely make sure that all attendees, actually I could do that, all attendees will get a link to the different trainings presently available, then you can choose to register. Doreen, our trainings are free. So this is something that we like to give back. It's value we want to provide to clients. Like I mentioned, the vision for Genghis Capital is to make investment as accessible as possible, as much as possible to the public. So all our trainings and sessions are free. Now, I think last time I learned a very painful lesson. I left out a couple of questions. So Churchill, Jeff, Gerald, have you spotted any question in the Q&A that I have forgotten? If not, hold your peace. And just as we come to the end of our session, I just want to say thank you so much again to Jeff. We've really enjoyed having your perspective on the derivatives market. I think there is so much interest in all our different sessions about derivatives. So it's definitely a product that a lot of Kenyans are starting to see the value. And as we have more discussions based on how can it be more accessible and how can people learn the value that it presents, I think we'll see more and more people adopt into the product. So thank you so much for joining us for this 1 hour session. We are going to definitely see how we can talk you into that training. So hopefully we shall see you very soon. Gerald and Churchill, you guys are awesome. I think we always appreciate the insights you bring when it comes to share trading, when it comes to fixed income, and when it comes to the macroeconomic environment. So that's great. And to all our attendees, we really love having you for this 1 hour on a Monday. I know for lots of guys, it's like, how do you start your Monday? And I think this is the best way to set the tone for your week. Just come, join us for an hour, get some insights that you probably wouldn't get anywhere else, and then engage with us, because Genghis Capital is very open in terms of education and making investments very accessible. So thanks so much. Make sure you register for the next session on Monday. Have an awesome trading week, and anyone who was to get any follow-up information, you will do so. But everyone who attends these sessions gets the usual link to the recording and the presentations. So see you on Monday. Okay, before I have seen some questions coming in. Okay, Eunice, because we like you, I think we are just going to take your last question. I know we were saying goodbye, but Eunice asks, when we talk long-term holding of share, how long-term is long-term? Then Gerald, today you're the one who's going to say bye. So after you answer Eunice, you can wrap up the session.
Yeah, okay, thank you. Yes, long-term usually tends to be relative. Sometimes long-term means 1 year. Some other times it could be 3 years. But for us, I think long-term ideally means a period whereby the market can ride out a cycle, for example, an economic cycle or a market trend. But ideally, for us, I think long-term, we usually look at between 3 and above years. I think within that duration, the market will ride out most of the short-term or economic shocks that be there. And I think that is an ideal period for where a market would ideally give some good returns. Yes. So,
all right.
Yeah, okay.
Okay, now Gerald has just like muted and left me. Anyway, thank you very much. You guys have a great week and see you on Monday.